One of the most enduring mantras in investing is, "The best chance to deploy capital is when things are going down." This phrase captures the appeal of buying assets when their prices have fallen, with the expectation that they will eventually recover and grow in value. The concept, often referred to as buying the dip, seems straightforward. Purchase investments at a discount during market downturns. Its simplicity is alluring, suggesting that periods of decline are opportunities rather than threats. For many investors, this approach promises a chance to maximize returns by taking advantage of temporary setbacks. The idea has gained popularity, especially in volatile markets, as people look for ways to turn short-term losses into long-term gains. At first glance, this advice may seem straightforward and even prudent. However, it's important to question whether following such guidance could actually be an intellectual trap. Many investors who embrace this approach often find themselves facing unexpected losses despite their best intentions. The underlying logic appears sound, yet the results frequently tell a different story. Why does this seemingly sensible idea backfire for so many? In the next section, we'll delve deeper into the reasons behind its widespread failure and explore the hidden pitfalls that catch investors off guard. In this section, we set out to uncover the subtle value trap concealed within a popular investment quote. While the quote may sound wise on the surface, it can lead investors astray if taken at face value. By examining its underlying message, we reveal why legendary investors approach value in a fundamentally different way. Instead of blindly following catchy advice, they apply a deeper principle that guides their decisions. Understanding this distinction is crucial for anyone seeking lasting success in the world of investing. Many of us have found ourselves tempted to buy into a market dip, only to watch prices continue to fall. It's a common experience, and one that can be both frustrating and humbling. Take a moment to think about your own investing journey. Have you ever bought a dip that just kept dipping? Reflecting on these moments can offer valuable lessons and help us make more informed decisions in the future. Honest engagement with our past choices is an important step toward growth and resilience in the world of investing. Imagine a well-known stock suddenly experiences a sharp decline in price. News outlets and financial commentators quickly label the situation as a discount, capturing the attention of investors everywhere. Headlines emphasize the opportunity, suggesting that now is the perfect time to buy. The familiar phrase, "buy the dip," echoes across social media and investment forums, fueling a sense of urgency. Many investors feel compelled to act, believing that purchasing shares during a downturn will lead to future gains. This scenario plays out frequently in the market, driven by both emotion and popular investment wisdom. Many investors are drawn to a reactive approach because it gives them a sense of being clever and contrarian. By quickly responding to market news or price movements, they believe they are outsmarting the crowd and capitalizing on unique opportunities. This feeling can be exhilarating, as it seems to set them apart from more passive participants. However, this is often an illusion. True investing involves careful analysis, patience, and a long-term perspective, rather than simply reacting to short-term events. The reactive mindset may lead to frequent trading and emotional decisions, which can undermine long-term financial goals. In reality, genuine investment success is built on discipline and strategy, not on impulsive reactions. One common mistake investors make is anchoring their expectations to a recent high price of a stock. This psychological bias causes them to view the previous peak as a benchmark for value, rather than considering the company's true intrinsic worth. As a result, they may feel compelled to buy shares even when the price remains inflated, believing it will inevitably return to its former high. This approach can lead to overpaying and poor investment decisions, as market prices often fluctuate due to factors unrelated to the underlying business fundamentals. By focusing on intrinsic value instead of recent price movements, investors can make more rational choices and avoid costly errors. The second flaw lies in relying solely on price charts while neglecting the underlying business fundamentals. Price movements can be influenced by short-term market sentiment, speculation, or external events, which may not reflect the true health or potential of a company. By focusing only on charts, investors risk missing critical information about revenue growth, profitability, and management quality. Understanding the fundamentals provides a clearer picture of a company's long-term prospects and stability. Without this analysis, investment decisions become more like guessing than informed strategy. The phrase, catching a falling knife, refers to the risky act of buying an asset while its price is rapidly declining, hoping to profit from a rebound. This approach often leads to significant losses, as the asset may continue to drop further. Emotional impulses, such as fear of missing out, commonly known as FOMO, can drive investors to make hasty decisions during these volatile moments. These actions may feel rational in the heat of the moment, but they are frequently rooted in anxiety and the desire to avoid regret. As a result, emotional choices can masquerade as logical strategies, clouding judgment and increasing the likelihood of poor outcomes. Recognizing this pattern is crucial for maintaining discipline and making sound investment decisions. The concept of buying the dip is widely celebrated among casual investors and social media circles. It suggests that any market downturn presents a golden opportunity to purchase assets at a discount, with the expectation of quick profits when prices rebound. However, this approach often overlooks the complexities of market cycles and the risks of catching a falling knife. Prudent investors, in contrast, rely on disciplined strategies rooted in thorough research and risk management. They assess the underlying fundamentals of assets, consider broader economic conditions, and avoid impulsive decisions driven by short-term market movements. By maintaining a long-term perspective and adhering to a well-defined investment plan, they aim to preserve capital and achieve sustainable growth, rather than chasing fleeting market trends. The true value investing mindset, championed by legends such as Benjamin Graham and Warren Buffett, centers on a disciplined approach to the stock market. Rather than reacting impulsively to market fluctuations, value investors focus on thorough preparation and research. They seek to understand the intrinsic worth of businesses, patiently waiting for opportunities where the market price falls below this value. This philosophy encourages long-term thinking, resilience in the face of volatility, and an unwavering commitment to sound investment principles. By prioritizing preparation over reaction, value investors aim to make rational decisions that stand the test of time. The first step in any thorough analysis is to gain a deep understanding of the business at hand. This involves examining how the company operates on a day-to-day basis, identifying what sets it apart from competitors, and assessing the factors that contribute to its success. It's important to look closely at the company's products or services, its market positioning, and the efficiency of its processes. Evaluating the quality of management is also crucial, as strong leadership often drives innovation and long-term growth. By building a comprehensive picture of the business, you lay the foundation for more informed decisions in subsequent steps. Step 2 involves determining the company's intrinsic value by conducting a thorough analysis of its financial fundamentals. This process begins with evaluating the projected cash flows, which represent the money the business is expected to generate in the future. Next, the company's assets are carefully examined to understand their true worth and contribution to overall value. Earnings potential is also assessed, taking into account both historical performance and future growth prospects. By integrating these elements, analysts aim to arrive at a realistic estimate of the company's underlying value, independent of market fluctuations. This rigorous approach helps investors make informed decisions based on the company's actual financial health. Step 3 emphasizes the importance of demanding a margin of safety when making investment decisions. This means only considering investments that are available at a substantial discount to their calculated intrinsic value. By purchasing assets below their true worth, investors can protect themselves against errors in analysis or unforeseen market fluctuations. The margin of safety acts as a buffer, reducing the risk of loss and increasing the potential for long-term gains. This disciplined approach helps ensure that investments are not only attractive on paper, but also resilient in practice. Step 4 emphasizes the importance of patience in the investment process. After identifying a promising asset and determining your target price, it's crucial to wait for the market to present the right opportunity. This waiting period can last for months or even years, as market conditions fluctuate and prices move unpredictably. By exercising discipline and resisting the urge to act prematurely, investors increase their chances of securing a favorable deal. Patience not only helps avoid impulsive decisions, but also ensures that investments are made at optimal times, aligning with long-term financial goals. A prudent investor does not react impulsively to falling prices. Instead, they establish a value threshold in advance, carefully analyzing what they believe an asset is truly worth. Only when the market price drops below this predetermined level do they consider making a purchase. This disciplined approach helps them avoid emotional decisions and ensures that their investments are based on rational criteria rather than market fluctuations. By waiting for the right opportunity, the prudent investor aims to maximize potential returns while minimizing unnecessary risks. Reactive dip buyers often respond to sudden market declines with quick purchases, hoping to capitalize on short-term rebounds. Their motivation is typically driven by immediate price movements and the fear of missing out on potential gains. In contrast, methodical value investors approach the market with patience and discipline, carefully analyzing a company's fundamentals before making decisions. Their focus is on long-term growth and intrinsic value rather than short-term fluctuations. While dip buyers may experience rapid gains or losses depending on market volatility, value investors tend to achieve more consistent outcomes over time by relying on thorough research and strategic planning. This fundamental difference in approach often leads to divergent investment experiences and results. In today's fast-paced world, it's easy to fall into the trap of equating constant activity with genuine preparation. Many believe that frequent trading or chasing the latest market trends is a sign of being proactive, when in reality, it often leads to impulsive decisions. This confusion extends to risk-taking, where speculative bets are mistaken for disciplined investing. True preparation involves thoughtful research and a clear strategy, while disciplined investing relies on patience and informed choices. By recognizing these distinctions, individuals can avoid costly errors and build a more resilient financial future. Acting impulsively on a quote without conducting thorough research can expose individuals to significant risks. Decisions made in haste, especially when financial stakes are involved, often result in costly mistakes. Without verifying the credibility of the information or understanding its broader context, one may fall victim to misleading advice or scams. Reckless actions can lead to unexpected financial losses and long-term consequences. It is essential to approach any quote or recommendation with caution, seeking out reliable sources and expert opinions before making commitments. Proper research not only safeguards your interests, but also empowers you to make informed, confident choices. The true path to building wealth is not about chasing quick gains or taking unnecessary risks. Instead, it centers on creating a foundation of safety and peace of mind. By preparing thoughtfully and maintaining discipline in financial decisions, individuals can navigate uncertainties with confidence. This approach emphasizes steady progress, avoiding impulsive choices that could jeopardize long-term stability. Through careful planning and consistent habits, wealth becomes a result of patience and resilience. Ultimately, prioritizing security and ease allows for sustainable growth and lasting financial well-being. True investment safety is rooted in understanding the intrinsic value of an asset and insisting on a margin of safety before making a purchase. This means carefully analyzing the underlying worth of a business or investment rather than simply reacting to short-term price declines. Buying during market dips may seem attractive, but it does not guarantee protection against loss if the asset is fundamentally overvalued. By focusing on intrinsic value and purchasing only when the price is significantly below that value, investors create a buffer against unforeseen risks and market volatility. This disciplined approach helps safeguard capital and fosters long-term financial stability. Peace of mind in investing often stems from thorough preparation. By understanding your financial goals, risk tolerance, and the fundamentals of your investments, you build a foundation that helps you navigate market fluctuations with confidence. When prices fall, prepared investors are less likely to react impulsively, as they have already considered potential downturns in their strategy. This foresight allows them to remain calm and focused, rather than succumbing to panic or fear. Preparation transforms uncertainty into manageable risk, enabling investors to stay committed to their long-term plans regardless of short-term market movements. The most important part of successful investing happens well before any market downturn. It's the careful research, analysis, and preparation that set the foundation for confident decisions. By thoroughly understanding companies, industries, and market trends ahead of time, investors position themselves to act decisively when opportunities arise. When the market eventually drops, the groundwork has already been laid, making the process of buying much more straightforward. Instead of scrambling or second-guessing, investors can rely on their prior research to guide their actions. This approach transforms uncertainty into clarity, ensuring that the actual buying moment is simply the execution of a well-considered plan. Adopting a disciplined, research-driven approach is essential for making informed decisions and achieving meaningful results. By consistently seeking out reliable information and analyzing it critically, you can navigate complex topics with greater confidence. We encourage you to reflect on your own research process and consider sharing the steps you take to ensure accuracy and depth. Your insights can help build a stronger, more collaborative learning community. Additionally, if there are future topics you'd like to explore, feel free to suggest them. Together, we can continue to expand our understanding and make well-founded choices.